Now, guys, you've told us that as interest rates go up, bond values, well, they go down. Somewhere along the line, interest rates will start to move down. So are bonds coming back into favor? And how long do you think that'll take for that to happen?
I think a big takeaway from this section is, are bonds making a comeback? The important thing is if you've listened to the show, we had talked in the past on our radio show a couple of years ago about what we feel was the high risk that bonds faced, as we bottomed out in the interest rate environment, and it was likely that interest rates were going to rise in the future. And so if you're a listener to the show in the last year or two, and your advisor or somebody that is helping oversee your investment portfolio hasn't sat down in the last year or two and have a conversation with bonds, and or if you own bonds or you're in a 401k and you have a target date fund, I really think that you should get a second opinion, because when we look at it and you look at the aggregate bond index and you go to a website like Morningstar, the yield right now is 4.7% as the end of November, beginning of December, and they have an average duration of 6 years. Now, Chaz, I know you have some comments about duration and yield, but when we look at it, the yield is still kind of low. It's gotten better over the last year. But when you add the yield and the increase or decrease in prices, year to date, bonds are actually only back to slightly positive. In fact, if you look at the last 3, 5, or 10 years, at least in my opinion, bonds using the, again, aggregate bond index, AGG, on Morningstar, have not even kept up with inflation, let alone if they're in a retirement account, you've got the other eroding fact of taxes will have to be paid on them. But in general, though, when we look at that, there's going to be some form of entry point in bonds. And so I'm not saying, bonds are dead forever. If I go to Yahoo Finances and I look at the AGG chart over the last couple of years, the bond index is still about 20% below its July 2022 highs. And when we look at the consumer price index, here's what's happened in the last couple of weeks, is you had the consumer price index was only 3.2 in October compared to 3.7 in September. So what is happening now, people are starting to say, well, maybe we're starting to turn the curve on the inflation problem. Maybe we're getting to the point where the Fed, is going to stop raising interest rates. In fact, if you look at the futures market, they really have priced in the fact that the Fed is most likely going to be done with raising interest rates. And so now the debate turns into, when they're going to lower interest rates. But when we were talking about this topic, Chaz, you brought up a good point, and that's what's called the risk premium trade-off between yields and what bond funds are versus other traditional fixed accounts right now.
Yeah, when we talk about the risk premium, Nolan, we talk about what is it going to take, or what's the extra return over and above a risk-free rate that an investor needs to get to entice them to make an investment in a bond or a stock or any other security that has risk to it. And so me personally, when I'm looking at a bond and I'm saying, okay, I can get, let's say, 4.7% on a treasury, let's say, for instance, which is a good interest rate. What are my alternatives at this point? And if I'm a riskier investor and I'm looking for a risk premium, I'm looking for something to something over and above that risk-free rate, I'm going to look for stocks. I think it's kind of like this ladder that people that were investing in money markets maybe move to bonds, bondholders move to common stock to international, and it's kind of like this big ladder that of risk that people, a mountain of risk maybe that people climb as these risk-free rates keep going higher and higher. So I think the higher the interest rates on a fixed basis, the more investors are going to start to look towards stock, or something that gives them a risk premium, something that they're going to get over and above. We've seen this in some consumer staples and some utility stocks where it's just not enough risk premium. Why would I invest in a consumer staple stock that maybe sells soup when you can get a risk-free rate at a particular rate? I'm going to take the next level up on the rung. So that's one thing. The other thing you talked about was the duration of bonds. The interest rates are still, if you have a long-term bond, your interest rate in this case was 4.7, and you've got a 6 year duration bond, it's just going to be a lot more sensitive. And then we've got the fact that the government is still has to issue a ton of debt in the next year and a half. So there's just a lot of pressure on bonds right now. I don't think the worst is over for them yet. If it were me, I'm looking more towards stock than bond at this point. I don't think they're back in favor.
In an environment where the 60-40 portfolio has really come under scrutiny, and not necessarily because of the stock side of it, bonds have certainly come into question, and it's not to say that you should not have them in your plan at all, but maybe looking at that balance differently, maybe looking at other ways to invest that 40% if that is your mix. The team at America's Retirement Headquarters, they can run the numbers for you and figure out how to figure out what's going to work best for your risk tolerance. Again, at the end of the day, that's what matters the most is your comfort level, and then create a plan around there. You need to take the first step and give them a call though. 419-794-3030 so you can start putting that plan together. 419-794-3030 or go into the website as well, arhq.com.